Hey everyone! Welcome back to the channel. Today we will talk about the circular flow model and GDP. Let's get right into it. The circular flow model illustrates the flow of money, resources, and products throughout an economy. In a simple circular flow model, there are two economic actors, the households and the businesses. There are also two distinct markets, the product market and the factor or resource market. In the product market, products, or goods and services, are supplied by businesses to the households. In exchange, the households spend money which the businesses collect as revenue. In the factor or resource market, the factors of production like land, labor, capital, and entrepreneurship are supplied by households to the businesses. The businesses pay for these resources which are counted towards their production costs, and households receive that money in the form of income. Income can be broken down into four different types of factor payments that go along with the four factors of production. When you sell land you get rent. When you sell labor you get wages. Capital gets you interest and entrepreneurship gets you profit. In some economies, the government is another economic actor. The government buys labor in the resource market and buys products in the product market. The government also provides public goods to both households and businesses in exchange for tax revenue. There are ways money can leave or enter the circular flow model. A leakage from the circular flow model occurs any time money leaves the economy. If you import a foreign-made product, save your money, or pay taxes, it is no longer part of the circular flow. An injection occurs any time money enters the economy. If citizens in other countries purchase U.S. exported goods, businesses borrow and spend loans from banks, or the government buys resources or goods from the markets, the money flow increases. Now let's move on to GDP. GDP or gross domestic product is the total value of all new goods and services produced within a country during a year. It is a way of calculating all of the economic activity in the circular flow model. Another way of looking at it is that GDP is a measurement of an economy's creation of wealth. GDP can also be used to measure a country's standard of living. In order to be included in GDP, a good or service must be brand new. It must be a final good, meaning it is not part of or consumed in the production of another good or service, and the product must be made within the country's borders. The nationality of the producer does not matter since the products are still produced in a certain country. There are many things not counted in GDP. Used products are not included because they were already counted in GDP when they were new. So used cars, or clothes from thrift stores are not counted in GDP. Intermediate goods are goods which go into the production of some other good. Tires in the production of cars is an intermediate good. The final car will be counted in GDP but the tire will not. Goods made outside the country's borders don't count. Financial transactions like stocks and bonds, and government transfer payments like Social Security don't count because there is no good or service being received. When calculating GDP, there are three methods that all produce the same result. The value-added approach calculates GDP by adding up the contributions or value added by producers or firms to make the final goods and services. Let's see an example. Wheat is sold for $1 and is bought by a mill to create flour that they sell for $3. A bakery buys this flour and uses it to make bread that they sell for $5. By adding up the value that each producer added, we get $4, which would be the amount that is contributed to GDP. The income approach adds all the payments received for resources or the factors of production. This included wages, rents, interest, and profit paid for resources in the economy. The most important method is the output expenditure approach, which adds up all the spending on final goods and services in an economy. The equation for the expenditure approach is GDP equals C plus I plus G plus X minus M. X minus M can also be written as X sub N. This approach adds up consumer spending on goods and services, investment spending which is spending by businesses, government spending, and net exports which is spending by other countries. Net exports is just exports minus imports. GDP is often used as a measurement of a country's standard of living, But this measurement is not perfect as it can both overestimate and underestimate the true standard of living for people within an economy. One limitation is population. A country with a high GDP may not have a higher standard of living if it has a large population, since the wealth is spread among more people. Economists use GDP per capita as a better measure of standard of living. GDP per capita, or GDP per person, is the GDP of a country divided by its population. This helps economists understand if a country is truly rich, or is just very large. Another limitation is the unequal distribution of wealth. GDP measures wealth but does not give any indication as to who is receiving the wealth and gives no indication of the income gap. The shadow or underground economy is also a limitation. In the shadow economy, goods and services are exchanged but no one is keeping track or reporting transactions to the government. This can include illegal drug sales or a teenager getting paid to mow their neighbor's lawn. This economic activity isn't counted, and so GDP underestimates economic activity. The final limitation is the environment. GDP does not account for the benefits of clean water or air and don't factor in pollution from production. Additionally, money spent towards solving environmental problems like cleaning up oil spills actually increases GDP, causing overestimation of GDP. That's all for today's video. Thanks for watching and make sure to like and subscribe. See you soon.